Hey guys, I'm William, and today I want to talk to you about the Silicon Valley Bank collapse and how it affects you. Last week, a number of banks collapsed, the first being Silicon Valley Bank, which was the second largest US bank in history to collapse. News is finally coming out only within the last couple of days. The Fed had already kind of had its eye on the bank. The bank was already under full supervisory review, given several citations that they had been given in previous evaluations that showed that they weren't taking enough initiative on issues about deposit liquidity, which ended up being the exact thing that the bank fell apart for. Before we jump in, I do want to say just please leave a like on the video, comment below some of your thoughts about these topics. I'd love to know. I've tried to respond to all the comments that I see, so I'd love to get a good discussion going about y'all's thoughts to kind of give us a good frame of mind about how we all feel about this. And also subscribe if you really enjoy the content. So to start, during the pandemic, Silicon Valley Bank saw a large increase in their deposits. From early 2020, they went from having around 50 billion in deposits to around 175 billion in deposits, which is a huge increase over a very short amount of time. Banks typically try and make money off of your deposits, and in most cases, they're looking to make loans. However, in cases like this where they get a lot of money in a very short amount of time, it's tough to get the same amount of loans through the process and approved. So, in instances like that, most banks will take their money and put their money into bonds. Bonds are an extremely safe way to make money, although return rates are relatively low. So, just for instance, imagine you take $100, you buy a bond, and in 5 to 10 years, you're going to get $101 back. So you've made a profit, but at the same time, very low rate of return. However, that return is typically guaranteed. So a bank does that with billions of dollars. And this is not really the issue. The issue is that they had purchased a bunch of these at very low returns, and the current market environment with inflation being so high and the Fed attacking it with higher interest rates essentially decreased the value of those bonds. By the time that all of this started happening over the last couple weeks, the bonds that Silicon Valley Bank held had declined about 60 to 70% in value on the secondary market from their par value that they paid for. Now, one thing that you need to know about Silicon Valley Bank is they had a large concentration in the tech industry in California. The tech industry was obviously one of the industries that profited the most off of low interest rates, but as interest rates rose, they were the industry that's probably been hit the hardest. You may have seen a bunch of the articles written about how Meta's let off a bunch of their employees lately, and you're seeing that widespread kind of across the board. So these companies that were once flush with cash, keeping all their deposits at a bank like Silicon Valley Bank, are now kind of starting to struggle. And over this recent time, they kind of started taking their money out of the bank. And so all these deposit outflows had essentially made it so that Silicon Valley Bank didn't have enough cash on hand to service all the deposit requests, which required them to sell these bonds before they were really ready to sell them. Had the bonds been allowed to mature, it wouldn't have been an issue. But now they're forced to sell these bonds at record lows, taking huge amounts of losses off of it. So they came out last week and basically announced they had taken these losses, and the stock price of the company immediately plummeted. As soon as that happened, it was almost unstoppable. Depositors panicked and began to take all their cash out. Here's where it's important to note how bank deposits work. Now, Signature Valley Bank was an FDIC insured bank, which means that all deposits up to $250,000 are insured by the FDIC. However, 97% of deposits were not FDIC insured. So you have to imagine there's a tech company out there who keeps $50 million plus in deposits at the bank. And if that bank goes under, they lose everything. It is gone. They will never see that money again. So it makes sense how all these customers did panic and want to go get their money out. But at the same time, as they began the run on the bank, Silicon Valley Bank is having to sell all of these bonds way below par value and is losing more and more money. Within a day, depositors had taken $42 billion out. The FDIC quickly came in and placed the bank under receivership, so essentially they took over the bank. It didn't help that during all of this panic, Michael Burry, who was famous for his role in The Big Short in the 2008 financial crisis, came out and basically said, "Is this the next Enron moment?" Further exacerbating the issue and causing more panic. Now, when the FDIC took over, they essentially quickly stated that even though the vast majority of the deposits at the bank were over $250,000, they were going to honor all the deposits at the bank. They did this and able to ensure the market that your deposits are safe and help prevent runs on other banks. However, at the same time, banks like Signature Bank and Silvergate announced mostly the same issues. However, the way they got there was a little different than how Silicon Valley Bank worked out. And at the same time, Credit Suisse in Europe, one of the largest banks in the world, decided it was a good time to also announce that they were having issues. What you saw last week was a giant sell-off in the financial sector, which caused most of the markets, stock markets, to sell off. It's important just to know that during this, the Fed decided to announce a lending program for banks where they could borrow money from the Fed at favorable rates to shore up their deposits. So if any other bank kind of came across this same issue, they would be able to loan money from the Fed at an affordable rate to make sure they had enough money to give to depositors without having to sell all these bonds for a loss. The reason why this kind of stinks is the fact that for the last 4 months, the Fed has been selling off assets from its balance sheet, trying to normalize the way that it works again, and essentially in a week this was entirely reversed. It's safe to say that overall everything is a little scary right now, and I think everyone has a right to be a little worried about the future. However, you should just know that if you have less than $250,000 in a bank account, you're okay and you don't need to go pull all your money out. There are also ways to shore up your money if you have more than that, either holding different accounts at different banks. Some banks even provide additional insurance on top of the $250,000. However, there's no bank in the world that can do enough to completely erase the risks of a full-on bank run. Now, right now, government officials are doing everything they can to make statements and comments to try and assure everyone that your money's safe, not to go run on the bank, not to pull your deposits out, not to sell your stocks. But there are issues here that are a little scary, and if it can happen at one bank, many people are wondering if they could happen to another. I'm also of the mind to believe that sometimes the press plays a role in trying to get clicks and using scary words and dangerous headlines, which potentially could cause market scares. And I believe that overall it's a little unethical and it's scary that they have that type of power. If you're the type of person to trust the government, there are a couple of things coming out in the future. The Fed announced an investigation and said that the result of that investigation of all these crashes and collapses would come out prior to May 1st. In addition to that, the House Financial Services Committee announced that they would be having a hearing on March 29th about all of these to try and sit around and make comments for TV, I'm sure. But if you're the type of person who appreciates that and thinks that the government is going to do a great job at really putting people in their place, those are the dates that you want to look out for. So the main concern for you is how should you feel about your investments? If you have a short fuse on your investments, you should really be looking for more safe havens right now, whether that be a savings account that's paying a 4% rate, or perhaps mutual funds or stock funds in companies that are a little bit more recession proof or pay a nicer dividend. If you're looking at long term, maybe you're not retiring for the next 20, 30, 40 years, you should really weather this. You should be looking for opportunities to dollar cost average into the market, maybe sell off some of your riskier parts of your portfolio, more speculative, definitely tech, but at the same time, you should be seeing lots of opportunities over the next couple of years. If you think about it, even if you bought in at the very top of the 2008 financial crisis, right before everything crashed, you would still have made a very pretty profit today. So I think overall, it's important to realize that the Fed and the government are trying to stay on top of this issue and assure everyone that they're okay, but things are still a little hairy right now. Leave a comment below. Let me know what you think. Do you think that we're going to be okay? Do you think that this is the beginning of the end? What are you doing with your money? Leave a comment. Let me know what you're thinking. Leave a like, and hopefully we'll kind of see how this plays out this week.